Well, hello, everybody listening and watching at home. Thank you for joining us for this second part of our ongoing conversations with Roger Urwin, who is a leading architect of total portfolio approach and many other really foundational and provocative intellectual big picture ideas that are reshaping the global finance industry. In my last conversation with Roger, we had talked about the kind of history and the context of TPA in particular as it pertains to differences with strategic asset allocation. Roger talked about lots of key points around company governance versus efficient investing trade-offs and the future of the human intelligence and artificial intelligence capability stacks and how TPA can help uncover these big systemic shifts and help us rethink from a systemic lens how to better allocate capital. So to make sure that this next piece of the conversation adds to that rather than repeats it, we are going to talk about what has changed, particularly now, the time of recording. This is January, and we've just gotten out of the 2025 year where Roger had been traveling the world, speaking with many different asset owners and others about TPA and kind of get his sense check of where things are at now, looking back over the year that just passed. We're also going to talk more about what doing TPA actually looks like in practice and how to transition safely with the right guardrails for anyone listening and thinking about integrating TPA into their own investment process. So with that, Roger, thank you. Welcome back to the podcast. And
Fantastic to be with you again, Mona.
good stuff. Well, we're so grateful to have you as well. You said to me when we spoke last, Roger, that the tipping point was 2025. We've crossed the chasm. Would you elaborate a little bit on that and speak to
Yeah.
where we've come this past year?
Yeah, it was a wow of a year for me, 2025, because I calibrated that basically I'd spent 3 times as long on TPA as the other subjects I deal with relative to where I was the previous year. So that was a very big takeoff in 2025. So lots of activity. I was doing projects, I was doing different things, talking about TPA, finding lots of people now wanting to talk about it much more than they had before. So that's kind of normal within the S-curve of an innovation that is landing. It's that point about landing. It has been landing for a while. There haven't been so many pushbacks against it, but what happened in 2025 was, particularly with some notable kind of new funds that were taking up the mantle, we actually got, I think, something much closer to a tipping point, a point of inflection. There are a gazillion ways to describe this kind of point of addition to where we were before, which actually is captured in that S-curve and at a point which is often referred to under the theory of innovation as crossing the chasm. Crossing the chasm is basically when the early adopters are able to influence the mainstream acceptance. And that's what happened in 2025. Mainstream acceptance kicked in because outstanding examples of funds doing TPA were evident. So first there was PGGM in the Dutch market, and then there was CalPERS in the US market, both making quite big changes in the way that they are managing. Well, CalPERS is more about what happens next year for what it's worth, but both of them were very popular, interesting discussions. And so what we had with TPA was, I think, a degree of, you could call it popularizing, you could call it normalizing, and even a bit of standardizing. And each of those actually progressed in 2025.
Well, that is terrific to hear. We, in other domains, I come from the sustainable investment world in terms of my career history. And one of the things that was certainly noticeable in the kind of mainstreaming of sustainability over the last decade was this notion of, the Gartner hype cycle and things having to plateau before we get to real scale. Where on that would you place TPA? Is that an appropriate mechanism for assessing where we are, or does this kind of, do we need to throw out the existing literature of how we think about change and systemic change with TPA? What are your thoughts on that?
Well, no, I think that the Gartner model and other models have, I think, worked on the principle that a number of stars need to align in order for significant change to happen. And change can actually definitely whimper out because the idea hasn't got enough compelling force. But I can only say that the reasons why people find it appealing here, the TPA proposition, are strong enough to move through. But it's the lack of awareness and the lack of time to transition that has held it back so far. So there are still, I think, growing pains for a bunch of years. I think I referenced last time that I was involved with SAA in the 1990s. That basically took more than a decade to transition to, having previously been all about performance in simple league tables. We moved to something much more sophisticated. And we now are looking at something similar, I think, in TPA, that it will take a bunch of years to transition. And we will, I think, talk about later on which funds are kind of most likely to benefit. They are the big funds who get the benefit of scale to apply to this type of proposition.
Absolutely. Well, you raised two really important things there. One, lack of awareness, and two, lack of time to transition. Let's tackle each of those. So, to help overcome the lack of awareness, perhaps maybe in simple, plain English, it would be really helpful if, and I know we probably did a bit of this in the last conversation, but perhaps there are folks joining us for the first time this time around. So maybe you could just humor us and give us a very layman's definition of what top-down TPA is, especially kind of level 3, and why is this the level seems to be scaling at the moment?
Okay. Okay. Well, just a reminder that TPA usually has three things spliced together. It is actually aligned to goals. It's really about best ideas, competition for capital. And then the last thing is really dynamism and resilience. Both of those are pretty important alongside each other. So when you have called out the one that you've referred to as top down, you actually do have to go back to the work being done by myself and others at the Thinking Ahead Institute. Now, over a period of time, Thinking Ahead has been involved with the funds that have been transitioning here. That's 2 decades of work, actually, for what it's worth. But essentially, TPA has been defined by Thinking Ahead to have different levels to it. And really, that was quite an important sort of step forward because people thought of it as a binary point. It just isn't. There are so many different features that you can build into your TPA, and not everyone wants them at the same time or even wants them at the end of the story. So from that point of view, you actually can think of different levels of commitment to TPA across a continuum, a spectrum. And the one you've referred to is called top-down TPA, and this is all in the public domain. Thinking Ahead has created complete open architecture about this being available for everyone to use. So in that area, top-down TPA is 3 out of 5, so there's 2 more levels beyond it. Very few organizations are right at the end of the TPA proposition. It's actually pretty much it's Canada Pension Plan and a couple of others. But essentially there's a level 4 one, which is also important. We call that joined up TPA. But the level 3 one you've come up with is actually the one that people find very appealing because it's got the biggest bang for your buck to most people. They can actually get to it without too much disruption to the organization. And that is really because the big addition to the organizational design is the concept of having a top of house function. And this is captured, I like to express it in terms of the fact you have a chief investment officer, but you also, in this type of situation, should really have a chief total portfolio officer. Bit of a mouthful, CTPO, right? So you've got a CIO, you've got a CTPO as well. And that individual is there to use the function of being at the top of the house to express rebalancing, to express individual top-down positions on the whole portfolio. By the way, this is really introducing factors and themes in a fairly significant way as well. And also to drive some of the portfolio construction from that point. But it's basically a top-down discipline. And a lot of it is done through overlay management. So individuals who are doing this actually have more of a technical job than the chief investment officer. They're taking, I think, guidance from the organization's decision structures in order to make sure that they express what the overall allocation should be, what the exposure should be at the top of the house. And with dynamism being this factor, this is a pretty active role. It's not like you're just doing this once a month. You are actually looking in on the portfolio, not in a tactical sense, but in this dynamic, strategic way.
Well, that's interesting because I think there are, and correct me if I'm wrong, but there are some other microcosm versions of this. So if you take enterprise risk and chief risk officers, for example, uh, they have an enterprise house view of risk, and it is dynamic in its management. It needs to be by definition. It might have still some periodic review periods, but I'm sure if something comes outside of that time frame or cycle, it will be given the attention that it deserves. And that often sets the tone for other decisions that get made across the business. So if I've understood this correctly, would the CTPO, Chief Total Portfolio Officer, have somewhat of a similar role, but specifically where the end goal is the asset allocation and the portfolio construction, but done in a way that's dynamic, that's responsive, that's integrated with the whole of the organization, and actually takes this kind of macro, big, systemic view and applies it through the various integrals and sort of the verticals, I should say, of the business and how it actually is managed day to day, culminating ultimately in the portfolio. Is that correct?
Yeah, very
Highly
well
simplified.
expressed. You got it. So I like the idea that you're bringing the verticals into something of a horizontal, right? You see, so it's total portfolio that's in the job title, and really from that point of view, a chief risk officer is doing something in a domain that is parallel to that. Obviously, the chief risk officer may have more interest or influence over enterprise risk relative to portfolio risk. But the key dimensions of portfolio risk have to be somehow managed, usually in this structure of three lines of defense. So that is happening anyway. But what is happening here is that the organization is really taking a much more direct route to managing its exposures at the top level. And again, I'm going to emphasize that one of the things that people always call out with TPA is, oh, we can do factors better. We absolutely can do factors better, not because you're jobbing in and out of factors, but because you can actually put structural and strategic positions in place that actually have a longer time horizon to them. And that includes, of course, all these exposures to different themes where technology, as an example, you put an exposure onto that theme. Now, what is the difficulty with a lot of this technology stuff at the moment is that people are actually being whipsawed by short-term benchmarking into having positions and then moving out of those positions, etc. Whereas the structural opportunity with technology here is actually handled through the CIO ship, which is coming up with the exposure, and the CTPO ship, which is actually making sure it's executed according to the spec. So the CTPO doesn't have the discretion to just do whatever with the top-down position. They're reflecting the views of the CIO ship. Now, I call it CIO ship because it's more than an individual who's involved there. You've got the IC-type structures within an executive that actually create a decision which actually is a reflection of some sort of cognitive diversity and collective discussion that actually produces something better than any single individual can produce. So yes, it is exactly that horizontal, taking all the verticals in, as it were. And of course, the big issue with that is what I call the intelligence stack, which has to be really on the money, consolidated everything, and actually giving you the exposures that actually matter in a fast-moving world.
I really like the example you gave about technology in particular, because technology and artificial intelligence is top of mind for every organization around the world right now, I am sure. And the this question of like addressing these risks and opportunities at pace, because things are happening so fast and we need to respond. But the challenge sometimes with that type of knee jerk reaction is you end up with an accidental system. You're optimizing on the margin every single time. And actually, what, if I've understood correctly, this CIO ship and CTPO ship partnership, lots of ships, can help create a coordinated, integrated response that is thought out through a longer term time horizon that co-creates from that horizontal kind of bird's eye view something that's actionable and intentional rather than, constantly reacting to these individual benchmarks and these individual metrics like at a moment's notice and maybe missing the bigger picture.
Yeah, really good. It is like that in principle. And the interesting thing is that the practice doesn't always deliver to that level of precision because organizations are still scrambling around to try and reconcile exactly what their positions are. Obviously, you've always got the issue about private markets, exactly what those exposures represent. And so from that point of view, you've got to do a lot of grunt work to get yourself to the point where you've actually consolidated at speed, of course. You're not really trying to take a decision even as little as 12 hours out of date. You're actually trying to actually have real-time stuff. Now, in all my work with big asset owners, all of them are kind of saying, "We're not even close to getting that perfect situation. We're sort of in work in progress on it, and we see the future, and we will get there. But at the moment, we actually have shortfalls, and therefore, we're not always consolidating the data with the speed that you want." So this velocity of intelligence is like a holy grail. And TBA can do great work on bad data, but it's not really going to be as good and as accurate unless it actually has that good data. And of course, that good data is the response to the analytics that are now extremely sophisticated out there with respect to exposures. Now, so from that point of view, there are a number of significant providers, vendors of different proprietary systems who are uh, really becoming a very important cog in the chain. And those providers, I'm not going to name them here, but there's 4 or 5 very credible organizations that are actually putting um, their analytics on the line to help organizations. And so from that, it's consolidation, real time analytics, and it's got to actually also be decision useful. And in that area, that combination, leads you to something that actually is a very powerful force. And there's nothing equivalent in the SAA space. You're just not taking decisions that actually have the same influence or impact.
Mm. No, that makes a lot of sense. I think the vision and the rationale is clear, certainly to me. The operating model and the day-to-day reality. I mean, we talked a little bit about the various roles that would have to exist and how they might work together. But just to really spell it out for our viewers at home who might be considering integrating TPA to their organizations, if I were inside a fund doing TPA, what recurring decisions would be getting made by whom, using what information? You'd already referred to some of those partners and those vendors that can help be that layer in between. But from within the organization itself, what decisions would I actually be making?
Yeah, so we start with the idea that you've got a portfolio that does represent a good proposition for your stated goals. Everything in TPA goes back to goals, which is, the way it should be. It's just not quite like that in SAA. But in TPA, everything comes to your goals, and therefore you start with a portfolio that actually is the most likely to fulfill your goals. Now, stuff happens, and so we are possibly next day, or it could be a little while longer. Something new has happened in the world, or something has happened in the circumstances of the fund. Now, it's more likely to be the first than the second. And really, from that point of view, the investment world genuinely has changed massively over the recent past. Now, this is all about what I refer to as the great acceleration, which is that basically the pace of change is still picking up. And as a result, there's more change that's coming down the pipeline, which actually creates more uncertainty with respect to current and future pricing of securities and different investments. And that therefore needs to be thought about in the context of maybe some changing circumstances in the fund. That's less likely. That will happen periodically, but less on the pulse and the drumbeat that actually is creating a world where particularly geopolitical risks, but also sustainability risks and risks of the energy system and risks of the security system have all become more significant and therefore likely to be things which you might well say, actually, something has happened here. And I actually can now dynamically see a portfolio that actually, for the long term, is better than the one that I currently hold. Now that's the gig. You've got to really actually look out there and actually understand that not every move is a random walk type move. Random walk type moves are fine. You know, you still got you can rebalance. That would be one of the ways of responding to it. But actually, where there's new information, you've actually got the possibility stroke probability that there's an investment opportunity that can be harvested. And at the very least, you're reducing the risk that has basically come out of those circumstances, the additional risk that you want to mitigate. It could be either of those points. You're investing to get a higher expected return, or you're investing to reduce your expected risk. But essentially, that's what's going on within a TPA type organization, that actually it's very fresh to understand that there's new opportunities that are arising every day, every week, every month. In a SAA situation, you've got to actually see it as actually it's a bit of about a quarter and a year. It's very, very differently positioned.
Yeah, it's far more structured and sort of routine, which is divorced from the reality of what's actually happening in the world potentially. So I do understand that. This great acceleration, as you call it, I love that phrase. Things do certainly feel that they are accelerating greatly. And I suppose having the goals that TPA offers is like your North Star that can help you ground in practice and in reality while things are shifting so rapidly. And I guess that if I've understood correctly what you're saying, the counter argument, like one of the reasons why some people might say, who are critics of TPA potentially, well, I can always rebalance my portfolio. Like, what's really different? Like, I can respond in real time, and while that might be true, I think this gets to the heart of, you know, if it's not connected to the bigger picture and the bigger end goal, you're just sort of optimizing on the margin. You may be creating an accidental system. You're not saying that SAA doesn't work. You're just saying that in certain cases, TPA is probably better, and here's why. So if you think that's an accurate sort of assessment of things, do let me know. But I definitely feel like sometimes the challenge with the naysayers is that they don't see immediately what the big differences are. And that's because it could sound similar if they feel that they can adjust their portfolio. And it's like, yeah, in its most simple terms, you have a portfolio, you're constructing it, you're allocating capital, and you're responding to the world at large. That core premise is not that different between the two, but it's how you do it. And it's the systems in place and the thinking around the integrated vision that makes TPA so distinct.
Yeah, that's right. So one of the criticisms of TPA has been, oh look, this is just old soup warmed up, and
It can
I
be
kind
quite
of get
nice
that.
sometimes.
Yeah,
Flavor
yeah.
marinates.
But it actually does come back to the incentive structure being very different between the two. The incentive structure within a normal SAA is very much oriented around the individual silos, the sleeves of the whole portfolio. And so you're not taking the same decisions at all. So roughly speaking, this is my rule of thumb. Some people would call it a factoid. It's roughly speaking that you've actually got 3 times as much going on in the portfolio, which doesn't mean that's all about turnover for what it's worth, but there's 3 times as much thinking and action that's taking place in a TPA situation, which actually is very interesting because it could be that you say, oh, I'm just not happy to be necessarily risking that extra bit of skill that might be required. And that comes back to the fact that you can't have a TPA situation that basically substitutes for skill. There's no point in going to TPA without an organization that actually has skill. But some of the best opportunities here are in this middle ground of themes and factors and dynamic strategic asset allocation, which is just has a different time and tenor to it relative to the tactical asset allocation that we know to be very difficult to execute successfully.
Mm, interesting. So very clear, and I think really helpful in terms of addressing those points we talked about, the the operating model day to day, the kind of simplicity of, well, putting it in simpler terms. Now, what about the guardrails to make sure that if you put this in place, you don't revert back to old habits? What can leaders and organizations do to establish a system of permanence and at least commitment to this? Because for all the reasons we've discussed, it on paper, they could seem close, and it could very easily, you could have scope drift back into the old methods, especially because organizations are, it's like a muscle. They have muscle memory, and things often kind of revert back to what we do and have always done. And this is certainly a big departure from that.
Yeah. Yeah, I love the word guardrails. It's a good one. And really, in risk, of course, you've got three lines of defense of risk. And it's actually relatively similar in TPA that you've got three lines of defense coming from governance. So governance is your number one guardrail. So governance starts off with trying to kind of tweak the governance setup such that the board or IC is actually giving detailed oversight into the portfolio and understands the portfolio. Now, not every board is going to be happy with that role, and that's one of the issues about how you might design this thing. But essentially, what you need is a strong oversight function sitting in the sort of periodic review category and actually being prepared to, from time to time, say, actually, I'm going to challenge that. I think you should actually look at that again. Or in some situations, just make the conversation go deeper than it has. So really, number one in governance is increased oversight. Number two is really this data. So real-time data, which is accurately building a picture about the portfolio's characteristics into the future, but also is all the time keeping score with respect to what's happened in the past. I call them dashboard looking forward and scorecard looking backwards. And the board needs that information, but everyone else needs it as well. It's kind of like you need your dashboards to communicate at different levels with different parts of the organization. And so this data thing has become a bigger proposition that you need in TPA. And of course, the technology is coming along at the right time to help with it. So AI is filling in gaps that have previously been problematic. I said that you have a lot of organizations saying we haven't really quite got the data yet. Well, trust me, AI is going to fill in that sort of gap over a period of time. So number two is data. Number three is strategic foresight. It's a subject that we've discussed passionately, Mona. So the strategic foresight, which actually is relatively weak muscled amongst asset owners, to think about the 5 and the 10-year horizon much more significantly, because there are new systemic risks lurking at that type of horizon. They haven't been manifest before, and we haven't got data on them really. And so this thing about data is, where's the data coming from? Well, basically, this is going to actually be shaped really about through judgment and assessment. It's not going to be shaped by extrapolating the past, because the past will not be a guide to those types of situations. So this macro foresight function has to be a combination between management and board. It's where boards actually can play a remarkable role, because they are able to, I think in that lateral way, bring different data points into the equation and actually put together a credible view as to some of these factors: geopolitical risk, obviously issues to do with energy security, issues to do with water and food security, issues, of course, to do with climate change. All of those things are actually starting to be more troubling, and they're therefore more likely to play their part in disturbing the future financial system.
Indeed. And I love this notion of a forward-looking dashboard and a historical kind of scoreboard. What are some example KPIs or actual performance metrics? Because the one argument might be made that when you have such metrics, you create a moral hazard. You're optimizing on those particular metrics because that's how you're incentivized and rewarded and acknowledged. But the point of TPA is bigger than that. It's actually the opposite of that in some ways. It's not to be beholden to these specific, you know, milestone posts, and be more responsive and more adaptable and agile. So how do you reconcile those two things?
Yeah, so there's a very simple description of what you need to do, which is called multiple comparators. So multiple means that if you rely too much on any single statistic, it drives your decision making, exactly as you say. There's a technical term for it. It's called munchkining. It's basically, when people kind of completely miss the point of the spirit of video games and actually just play for the points as opposed to playing for what's supposed to be the pleasure. So munchkining actually takes you to manage the outcome in a way that's counterproductive. You're kind of you're meeting the test of performance, but you're missing the point. So you've got to therefore measure more things and place a bit of sort of bulk reliance on different perspectives on how it's going. And really, people unfortunately have always given to past performance statistics too much credit in terms of its inferential quality. It doesn't tell you a huge amount about the future. And really, from that point of view, on a forward-looking dashboard, you want to know what's going to go on in the portfolio, and that's not really going to come from a past performance statistic. Yes, of course, you're at one of the multiple comparators is performance, and it will be a performance figure that's a bit similar to the one you've had before, but you actually have a bunch of other figures that are actually giving you a more full and holistic picture of the whole. So that is the kind of the big step forward. And really, this actually is starting to be very interesting in terms of the fact that what I call the guardrail here, which is the measurement system, is actually a gateway to better practice. So those guardrails and gateways go together. The gateway is basically, look, you can actually open up to a more sophisticated risk model than you had before. And I talk quite a lot about risk 2.0, which is basically taking risk wider, which is really about multiple circumstances in the wider environment, taking risk softer, which is basically seeing the narrative ahead of the figures, and then taking risk longer, which is about time horizon. So each of those is actually playing a part in a fuller risk picture.
Love that. So we've got lots of different KPIs that are not
Lots
individual
of KPIs. By the way, lots of KRIs, key risk
RIs. Yeah,
indicators. Yeah,
that's right. And no one in particular is the silver bullet. You've got to
absolutely.
sort of
Yeah,
balance across all of them. Which begs the question, you had mentioned earlier in one of your responses that you can't substitute skill, and skill and the right skills are going to be absolutely critical for organizations that successfully move to TPA. What are those skills? And I'm asking perhaps somewhat selfishly, as a representative of the CFA Institute, we are in the business of trying to equip the profession with the skills that they need. And so what are some of those skills, and where's the biggest gaps from where we are today, and what skills may be needed to make sure this operates effectively?
yeah. Yeah, I think as you look at it as an end-to-end thing, you've actually got to start with mindset almost before skills. So mindset is actually the state of the mind. You could call it an investment philosophy or philosophy generally about the way that the world works. It's actually captured by this word beliefs, of course. And then really you start with that type of philosophy. What it should produce is a bunch of angles, perspectives, attitudes that take you into the portfolio construction itself. And so from that point of view, when you look at it through that lens, you've really got to have very, very good critical thinking, systems thinking at the center of this in order to be able to operate this portfolio that is doing heroic things with respect to all this uncertainty. Just think about it that way. There's more uncertainty than ever before. That's what the great acceleration teaches us. So from that point of view, you're doing more to understand what those uncertainties might lead to. That's about scenarios. And as a result, you're creating portfolios that have more resilience. And that is the very precious skill here, is the ability to say, I've actually created a more resilient portfolio, as in it's more likely to perform in all weathers. But I've also created an organization that is prepared and adaptable when adverse circumstances manifest themselves in the future. So that resilience is a skill which is bigger than the one that we've had before. Now, in a little bit of work that I've just put out, I kind of made it clear that really that sense making is a special thing given all of that uncertainty. But on top of the sense making, I think one of the key dimensions of this is the ability to build your views up by referencing other people, by drawing from other people. And so the second most important element of this is the ability to build your network and improve your perspective on what's going to happen next.
Well, that's actually quite encouraging because as we all have career anxiety as AI risks replacement and labor substitution, the things that come up again and again as the saving grace for humanity, to put it in extreme terms, is our ability to interject that human in the loop sense making thing, and also the human connection and the softer skills that you mentioned around networks. And so in many ways, this is quite encouraging. This hand in hand with the disruption that AI will bring about, which I know we talked a lot about last time, but from a skills and future kind of workforce perspective, this could well be part of the solution to the puzzle of making sure that we are utilized in a way that is additive to the system and efficient from all perspectives.
Yeah, I really like the way you've described that, and I think it is encouraging, at least for the foreseeable future, that investment professionals can really edge in this direction by being better at sense making, bridge building, and one more, which is systems navigating. And that one's a little bit more of a mouthful, but it's really, really important that you've got individuals who are able to understand the systems that they reside in. You reside in a community system, you reside in an organizational system, you reside in a national system, you reside in a world order type system. Understanding how to work with them and to navigate through them. Now, the big navigation you have to do is within your organization in our industry. And that has become more difficult because our organizations have become more complex, and they have at times, stretched anyone's ability to know quite what's going on. And so from that point of view, the ability to be situationally fluent in a system has become a new type of skill. By the way, whenever you sort of use this word system, you're just conscious that people don't really like the word. It's sort of associated a lot with technology. But TPA is a system. I mean, really, the word system at its basic level is just a structured, clever way of getting something done. That's what you need. You need a system. You need a system for managing money. You need a system for managing your organization, et cetera, et cetera. That's what a system is. But it's not quite as simple as that. When you actually understand some of the background here, which is based on complexity theory and systems theory, you know that there are a number of kind of pretty helpful theoretical parameters that you can employ to understand that system better. And so defining a system in terms of its elements, its connections, and the purpose it serves, gives you a view of certain patterns. I'll give you an example of that. It's a very simple one. What gets measured gets managed. That is a perfect expression of what's going on in a system. Wherever you see measurement, people follow. And so from that point of view, you've got to turn that one round and actually use a measurement system that actually is right for your particular goals, which is why I was introducing that multiple comparators point.
I love it. And actually, I know you've been very involved in this. We at CFA Institute do have some research on this complexity thinking. Genevieve Heyman, among many others, and yourself have really driven that narrative. And we've got lots of research that can help point folks in the right direction to get to grips with some of these mental models and mind shift before getting to the place of sense making, bridge building, and systems navigation. So with that, Roger, I think we've covered a lot of the key things we wanted to today. So perhaps just with one last closing question, I'm going to ask you, if you have to leave our listeners with a sort of elevator pitch summary or a one-page mental model of how TPA, of a model of TPA now that's moved from idea to operating model or operating system, I should say, what would it be?
Yeah. Yeah, I'm glad you put in the word system there. It is a system, right? So TPA is a system, right? So it's got to be started off in the ideas era. I talked about mindset, but really the most important thing here is understanding the investment world as a complex adaptive system with behaviors that matter more than we've given credit. Basically, we've grown up with MPT being a relatively narrow discipline. It's based on Newtonian mechanics. It's not quite happy with elements that come from the squishy side of life, the social side of life. So really from that point of view, the mindset and the thinking has to be pretty flexible. And that introduces the need, particularly for the attributes of curiosity and reading people. That was another point on my list of things that are absolutely crucial for investors to work on into the future. But as you then start with the mindset, the system, the operating system, is really based on the idea that you don't get anywhere without a way of working which is set down and appropriately documented and streamlined and industrialized and works in scale. And I'm going to say normalized to some extent, but all of those things are needed in the process. This is what we seek in TPA at the moment, because there aren't perhaps enough early adopters to really make it clear exactly how those things fit together. But that's the portfolio construction side of it. And alongside that, alongside everything, it's got to be joined up. It's got to be joined up with respect to the measurement. And the measurement is a piece that actually we're sort of evolving a little bit more, understanding that measurement is more subtle than we've given it credit, because of this munchkining problem and things like that. You don't want to be too singular about it. Alpha is actually is a somewhat counterproductive measurement. There's nothing wrong with alpha as a value-added concept, but its measurement is problematic. And it's one of those things where I think people don't recognize enough that the alpha at any point in time sort of has kind of often borrowed or taken something from a different period, the previous period, the following period, because it's not a precise way of measuring the progress in a portfolio. It's basically a bit like a sample. And people don't necessarily measure properly for reasons to do with being kind of given this feed, which is, we've got all this 100% accurate information, correct. It's got high provenance, but it's got very weak materiality. So we can't understand the signals that come from past performance that easily. And that's actually, it kind of does your head in. It's not
But
easy.
it not only does it do your head in, Roger, it actually, and I think this is partly what's so challenging, it contradicts the paradigm upon which many of us were educated. So myself being an economist by background, it completely contradicts the ceteris paribus, all other things equal, which is why I think I'm glad I corrected myself and you picked up on it too. We're not talking about a model here. We're talking about a system. And a model is a intentionally overly simplified schematic to help understanding of a broader complexity. But actually, we're trying to bring the complexity back, because the complexity is the key to unlocking what's really happening. And so you have to be able to spin multiple plates all at the same time.
Perfect. So I've got a phrase for that: complicate to understand, but simplify to act. That's basically what you've got to be up for here. So really that therefore does define an operating system that people follow. They can actually understand it because it's been worked on from a sophisticated point of view, but actually it's been boiled down to some simple principles here. And then the last piece of the operating system is, of course, an organization that is in what I'll call flow. So flow is really when you've got all the energy going, when you've got all the cohesion going, when you've got the right type of behaviors and culture all operating well. So obviously that's the paragon that we all want to have from our organizations. It's tough, but it's then that you've got the ability to apply yourself to the task, which has clarity and is one of those things where everyone can agree this is really worthwhile. This is really what drives my passion, is the idea that we've got the opportunity to use investment thinking in a kind of a new gen way. I call this Gen TPA near enough. It is really a new generation thing to be out there producing better outcomes for end savers. Now, if we take a zero-sum alpha proposition, one organization's alpha is another organization's lost alpha. But there's so much that is not in that area where strategic benefit can come from designing your portfolio to meet your goals. There's so much money that's left on the table because we haven't really respected those types of ideas. And by the way, it is about upside, but I've got to be worried as well that it's also about downside, because the need to be resilient has never been bigger.
That's right. Well, I think you put it perfectly when you said complicated to define, but simple to act. And my hope is that, though still complex, our viewers at home do feel a little bit more educated on the topic. I certainly do, and have the confidence now going forward to act on this. And we will endeavor to continue to provide, with all of the work that you're doing with Willis Towers Watson and also here at the CFA Institute, the body of research and guidance and frameworks to really help the investment industry consider whether or not TPA is right for them, and then if so, how to tactically go about it. So more on that to come soon. Watch this space. Roger, thank you so much for your time and ideas and sharing them so generously with us. As always, you've been a pleasure to speak with, and I look forward to our next conversation. Thank you so much,
Yeah,
Roger.
perfect. Thanks very much, Mona. Really enjoyed it.